if you were to ask me next year today, where will the S&P 500 be? I would say Fox Business always calls me the world's youngest gold bull.
What happens usually to the S&P after a Fed pivot? Does it usually
Sure,
go up
yeah,
by 1,000 points?
So
Adam Kobeissi returns to the show. He is a founder and editor-in-chief of the Kobeissi Letter. Check out his work. He's very active on X. He posts a lot of his economic updates pretty much every single day, several times a day, and we're going to be talking about his latest analysis on the latest data surrounding the labor market, inflation, Fed policy, stocks. Where does he see stocks headed? The housing market. We'll cover a lot of ground today. The most important questions that the average person in America needs to be paying attention to right now. Adam, welcome back to the show. Good to see you.
Great to be back, David. Thank you.
I want to start by talking about the labor market. This tweet in particular, the current number of available vacancies is only 4.3% above the pre-pandemic levels seen in February 2020. Postings have now declined for 3 years straight. This is a chart you've posted from the St. Louis Fed website. And then concurrently, you've also tweeted, this is concerning. U.S. aggregate weekly hours worked has fallen 0.2% over the last 3 months, the largest decline since the 2020 pandemic. 3-month percent change in aggregate weekly hours worked in the private sector. You've also made a number of other tweets surrounding the labor market. I'm just going to ask you this as a broader, general first question. Should the average person be concerned about layoffs going into 2026?
Look, I think right now what's happening is it's no secret. The labor market is weakening, and the Fed leaned very heavily into that, of course, in their latest interest rate decision. So it's pretty well known now. Now, does this mean that we're going to have mass layoffs and it's a 2008 style event where unemployment's going to skyrocket and everyone's going to be, in trouble? No, not necessarily. I think we're just seeing some pretty typical cyclical weakness. You're starting to see some AI disruption. You are seeing some jobs being replaced by AI and technology. And you also are seeing underemployment is pretty high. So there's unemployment, right? But then there's also underemployment. And like I was looking at the 3-month average of youth underemployment is at 17%, which is the highest since the pandemic, nearly in line with 2001, 2008 levels. And even at a high level for the entire economy, it's above 8%. So I think, yeah, you are starting to see some signs of weakness. I don't necessarily think this is something that everyone has to panic about and that we're going into some massive recession that is gonna be 2008 like. It's just probably more cyclical weakness amid disruption, new technology, and the economy is evolving. That's the way it works.
When we say that the labor market is weakening, what does that word weak actually mean, practically speaking? Are we talking about fewer job openings? Are we talking about more layoffs? Are we talking about real wages stagnating? Jerome Powell, Fed chair, has also not just implicated this, but said outright that he sees a weakening labor market as one of the reasons for why he cut rates at the last FOMC meeting. So what does the word weak actually mean, Adam?
Yeah, I mean, it's a little bit of everything that you mentioned. I think it starts with job openings. It starts with these initial jobless claims kind of rising. And then it spreads a little bit. You start to see, and real wages is an interesting topic. You brought up real wages. It's going to be an interesting time because inflation is still running above the Fed's 2% target, near 3%, above 3% on some metrics. But then the labor market is weakening. So it will be interesting to see what's going to happen with wages. I don't necessarily think wages are going to go down, but they probably won't outpace inflation over the near term. And you also will see job openings decline as we're seeing. But again, I think this is all just cyclical. It's amid a pretty big disruption from AI. And I think eventually everything will iron itself out. We're just kind of due for a bumpy road ahead, which doesn't necessarily mean, and this has been my call for a very long time now, which doesn't necessarily mean we're going to have a crash in asset prices, right? You can have weakness in the labor market with higher inflation, also known as stagflation, as we're starting to see now. but not necessarily have assets crash over the near term. And we've actually seen that now over the last few months.
Yeah, that leads to my next point about what to actually trade. A lot of the economic data that we're seeing right now, and you've been tweeting this as well, including the labor market data, showing signs of weakness in the economy. At the same time, assets hitting new all-time highs. Bitcoin, gold, stocks. The S&P is hitting multiple weeks, week after week, all-time highs throughout the year. So what does this mean? How should we actually trade the data? Should we be trading the data at all?
Yeah. So, this is something, this is a topic that we've really been talking about, a lot about. And I think, a couple months ago, we put out a thread on Twitter or an X and a research note basically saying, it's a great time to own assets or you're going to be left behind. And I think even the last few weeks have kind of proven that. The initial reaction to the Fed meeting, we're seeing all assets. I mean, gold is up 4 times as much as the S&P 500 amid an S&P 500 bull market year to date. That's like typically, gold and the S&P move inversely, right? Gold is a safe haven asset. The S&P 500 is a risky asset. But what you're seeing now is the market knows that the Fed's dual mandate, which effectively means they want to control prices, limit inflation, and also control limit upsides in unemployment, so keep unemployment low. Their dual mandate is now conflicting. And by the way, Powell also said this exactly word for word himself. Um, you know, Inflation risks are to the upside and employment risks are to the downside. So the market knows that, look, we're not getting to the Fed's 2% inflation target. We're probably going to run around 3%, maybe a little bit higher, depending on what happens going forward. But and by the way, you also have in the background the biggest technological revolution since the internet, which is AI. But then now you're going to have easier monetary policy from the Fed, and I think that's a very powerful thing that the market is still pricing in. I think over the near term, you're going to see some more volatility, but I think if you were to ask me next year today, where will the S&P 500 be? I would say we'll probably be close to 7,500. And I think that could even be like just the base case assumption. So as long as the Mag 7 companies and tech continue to pump hundreds of billions of dollars into AI CapEx, the Fed is cutting interest rates, and inflation is running above 3%, it's going to be, in my view, a rush into any search for yield, right? That's what people are going to continue to search for. And I think they're going to continue to find it in a lot of these risky and safe haven assets like gold, Bitcoin, and silver, and these other assets that have performed exceptionally well amid a pretty remarkable run in equities.
Before we continue with the video, let me tell you about a very important topic: how to protect your privacy. Now, your private information doesn't just live in the inbox of your phone. It's being collected, packaged, and stored and tracked by data broker websites all over the internet, even without you knowing. That's where today's sponsor comes in, Delete Me. I use Delete Me to protect my privacy, and here's how. It helps you. It's a platform that helps you remove your personal data, like your name, address, and contact info from hundreds of these data broker websites. When you sign up, you'll get a detailed privacy report showing where your data was found and what's already been removed. And Delete Me keeps working throughout the year, scanning and clearing your information regularly. It's an easy way to take back control of your digital footprint without trying to track everything down yourself. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout to get 20% off of US plans. Link down below, or scan the QR code to get started today.
The fact that you think the S&P will gain another 1,000 points, can you just elaborate on that? Is that based on historical precedents after a Fed cut? I mean, what happens usually to the S&P after a Fed pivot? Does it usually go up by 1,000 points?
So yeah, we put out an actual a note, like a research note that kind of looked into what happens when the Fed is cutting interest rates with the S&P 500 at all-time highs. And by the way, this has only happened, right? September's rate cut was the third time since 1996, the third year, I should say, since 1996, where the Fed began cutting interest rates with S&P 500 near record. Last year, 2024, September 2024, was also one of those times. And as you saw how the market has performed since then, in 100% of cases where this has happened over the last 40 years, we've actually, or close to 50 years actually, we've actually seen the S&P 500 end higher 1 year, 12 months later. And that's usually an average gain. And Morgan Stanley put out a note on this as well, saying the average gain is roughly 15%. And that's kind of part of our base case assumption here. I also just think that AI capex is going to remain extremely robust. You're starting to see these tech giants like Nvidia and Oracle and these other names that have kind of started leading the market or have continued to lead the market higher pivot into the next inning for AI. So I think that's going to continue to drive equities higher. And ultimately, you also have an administration right now that is obviously highly cognizant of what's happening in the market and supportive of higher asset prices, combined with this whole deregulation wave that we're seeing. So I think it's just there's so much momentum right now. It's a tough trend to fight. I will say, like I've said already, the next month or two, yeah, we may see some drawdowns, and that's completely normal. When the S&P 500 rises 40, close to 40% in 5 months, even a 10% pullback would be warranted by both bulls and bears. By the way, bulls love pullbacks because you can buy these quality names for much lower multiples than what they were at just a few weeks ago with the way the market moves these days. So that's kind of the high level basis of how we came to that conclusion.
This is an interesting tweet. Retail investors piling into the stock market, according to Goldman Sachs. Weekly retail purchases were the largest since December for the week ending Wednesday. This is 4 times above the 2020 to 2024 September daily average. In the second month straight, where buying exceeded the prior 4-year average by this much. Retail investors are piling into the stock market. What does it mean? What does it signal when retail investors are piling into the stock market to this level, Adam? Is this, some people would interpret this as saying this is probably the end of the bull market, is it not?
So and this is a great chart because if you take a look, retail has absolutely crushed this rally. If you look at, let's just go right back to April and right when we were in that tariff crash, retail was basically buying all the way into that spot, and even after that spot, it's been pretty consistent net inflows by retail investors. Now, if you look at institutional flows during this same time period, retail was actually right. So, a lot of institutions were not only selling but shorting into what has been now one of the best 5-month rallies in the history of the S&P 500. And I actually think I'm not necessarily looking at this and saying, oh yeah, retail is now buying the top and we're going to crash and everyone's going to be trapped. What I view it as is, look, now if you look at the flows for institutional side of things, there are actually large net purchases happening week over week. And I think institutional investors are now saying, all right, if we missed part of this rally, how do we answer to our investors in Q3 and Q4 and Q1 of 26 if this continues and we're not even short, necessarily just not participating in the market or more in cash? So I think cash levels have come down for both retail and institutional investors purely because it's just the market has been so strong that no one wants to step in front of it for now. And I think that's in a way kind of driving itself higher. So I will say, like, that in a way does sound like a top type sentiment, right? I have to buy because that's the only thing you can do. But you can't ignore the other big macro drivers in the background that are happening, and that's why I think that we will see brief drawdowns that could exceed 5 or 10%. But I don't necessarily think that's going to derail the market in a way that we saw in early 2025.
Sure. Were you bullish on the stock market all year round, Adam, or was there a point throughout 2025 where you became a little bit more bullish?
Yeah, so I would say in the early part of the year, we kicked off 2025 pretty bullish. I think as the tariff situation started playing out more, and the S&P 500 clearly reversed its uptrend that was seen throughout 2024, we shifted more bearish. And it wasn't necessarily even a long-term bearish view or short-term. It was more just kind of playing these near-term swings. It was a remarkable time to trade, to be honest, in Q1 and Q2 of 2025, because the moves that the S&P and commodities and bonds were seeing on a daily basis sometimes were exceeding the annual moves that were seen in those assets just because of how much uncertainty there was. I think heading into May and June, we started shifting a little bit more neutral until we knew what was really happening with tariffs. And then from there, we've kind of just been progressively raising our S&P 500 target just because of this huge push into AI, this CapEx situation that I explained already, and now this Fed pivot coming into inflation, I think is adding more fuel to the fire over the medium to long term here.
This next tweet highlights the concentration risk that I've heard a lot on my show. Another day, another record. The top 10 stocks now reflect a record 41% of the S&P 500's market cap. To sum up, tech stocks effectively are the stock market. So if you're bullish on stocks for the long term or even the medium term like you are you then just basically saying you're bullish on tech? And another way to put this is, let's say if you just take the Russell 2000, for example, which has been lagging the S&P 500, not just this year, but for the last 5 years, could you be less bullish on, let's say, the rest of the stock market that's non-tech?
Right. So it's a great question. I mean, the chart you have up here, it's definitely something that I wouldn't necessarily is alarming, but it's something that you can't ignore. Now, this has really been the case now for the last 2 to 3 years, where tech stocks effectively are, the stock market, and they are driving this run all the way across the board. What I will say about it is, though, that the names that are driving higher are the names that are kind of evolving the entire world, the entire technology and just business landscape as a whole, right? The NVIDIAs of the world, even Meta now becoming one of the biggest companies, Tesla, Microsoft. These companies are massive. I mean, NVIDIA itself is bigger than almost every stock market in the world except for a handful. So, you as an investor, if you're buying an S&P 500 index fund, yeah, almost half your money, 40% of your money is going towards just a few names. But I don't necessarily view this as something that is, I wouldn't call it polarizing in either direction. I think what it really means is that when we do see these names move to either direction, it will drive the market, as we saw earlier this year and now. But I think generally, I'm pretty bullish on these names as a whole. So that's why right now, over the short term, it's not something I'm saying. I continue to emphasize this point, and it's not something I'm saying is bearish necessarily or even bullish. It's just more a trend to keep in mind, and know that, yeah, you do have outsized exposure to a lot of these big companies that are at the forefront of the AI revolution.
Okay, that's important to note. To your earlier point about how bad news could just be interpreted as good news because it's going to incentivize the Fed to cut, let me just ask you a hypothetical. What if the Fed disappoints and if they don't cut as much as we would want?
And then I think that would definitely be a major blowback to the bull case. Right now, the market is pricing in cuts preemptively. If the Fed decided to come out and say, we're not cutting interest rates at all for the next year until we see inflation back to 2% or whatever variation of that it may be, that would absolutely, send yields higher, send stocks lower. But I think you also have this interesting backdrop right now where Powell's term as Fed chair has a few months left. May 2026 is really his when he will be out. Obviously, Trump has made it very clear that he will be out. And the people that Trump is not only putting on the board now, but also considering for Fed chair are like, you saw the dot plot, right? Like the most recent Fed governor that was appointed by Trump was like in his own camp. It wasn't even like an extra rate cut or two.
I think there was a dissent. He wanted 50 basis points last exactly
meeting, yeah. and I think he wanted over 100 basis points this year alone. So
wow.
I think the market will continue to price that in. And I think as long as Trump sticks with this narrative, and I think the only way, by the way, that Trump's narrative can change is if we have some huge resurgence in inflation where he really just can't say anymore, we need to cut rates, because people will be feeling the pressure of higher prices, right? I think right now people are feeling the pressure of higher prices, but it's not like it was. Not that prices have come down, but the rate of change has definitely come down. And then also the market is doing well. So when the market is doing well, it's pretty easy to say, status quo is pretty good. Just cut the rates and we'll deal with it. And he's alluded to this, by the way, like in those Truth Social posts that he made in the summertime. President Trump, and some of them said, I think we should cut rates by 100 bips, 200 bips. And if inflation comes back, we can raise them again, or we can stop. So he did say that at one point, and I think he does know that. But I think over the near term, the market's just going to continue to, even into early 26. I don't really think the market is going to price out interest rate cuts. Even if the Fed starts saying, oh, we're going to go on pause, at some point, the new phantom Fed chair, who's going to be announced by the Trump administration in the coming months, will have more impact on monetary policy than Powell, just because markets will start looking out beyond May 2026.
All right, so a few certainties we know based on what you said. Powell's going to be out next year. Whoever's going to replace him, we don't know exactly who yet, but whoever's going to replace him is more than likely, almost certainly going to be aligned with Trump on lowering interest rates. How many rate cuts up for debate, but it's going to be lower for sure. Now, the question is, what is that going to do to inflation and growth? This is a very important tweet you've made. 72% of CPI components are now surging faster than the Fed's 2% target, the highest share in 3 years. Okay, I'll let you explain that. I'm just thinking, look, if let's say they cut into a rising inflationary environment, the general American public isn't going to be happy about that either. Of course, the Trump administration will blame all sorts of things on inflation, not the Fed, if they point, a Trump-friendly Fed governor. But it just doesn't look good. But anyway, I'll let you comment on this. Suppose the Fed actually does care about inflation. At what point does inflation surge out of control, so to speak, eclipsing the weakening labor market that they have to deal with?
Yeah, so it's a delicate balance because you're moving in opposite directions on goals that are supposed to be moving in the same direction. So it's what happened was inflation was the biggest risk. And then the labor market started weakening. And then the labor market, it's not that inflation got that much better. It's just that the labor market got that much worse. And now if the labor market can come back in and inflation starts getting worse, then yeah, you're going to see the Fed pivot again in the hawkish direction. The thing is, though, is I think the labor market is really weaker than most people think it is. And I think the Fed knows this. So it's not like it's head to head right now. I really think the Fed would be pretty happy with inflation running at 3% or a little bit above 3% if they can contain the labor market before this gets much worse. And I again, part of my bull thesis over the long term is the fact that inflation is coming back and rising again. I really do think that will drive asset prices higher, especially on a nominal basis. We saw that before. We saw that in right after the pandemic. Similar kind of situation. I think the Fed, they're not going to just completely take another 180. They need to see more evidence, and that will take months, by the way, months of labor market data to say, yeah, the labor market is now in control or the labor market is now strengthening again. So when I'm looking out with the projections, and we're typically looking, a few months out to maybe a year out at most, we're not looking 5 years out necessarily. I think that really does support the bull case, and I think dips will continue to be bought even after maybe a near-term correction happens.
And just on that note, a lot of major companies, Adidas, Walmart, Home Depot, have just recently in the last month announced that they're going to raise prices soon. So we may see higher prices next quarter reflect. So we'll see what happens. What is your base case for how the CPI is going to trend in the next quarter or two?
Yeah, I think we're going to see, the 3% plus CPI, especially on a core basis. PCE is probably going to inch above 3% on a core basis. And this was also the first Fed rate cut in over 30 years with core PCE inflation at or above 2.9%. So we have a high baseline to start with. And I think the other mystery here that the Fed is kind of weighing is, are tariffs going to have the inflationary effect that some thought they were going to have in April? As of right now, I would say it's not nearly as severe as some were expecting. The question is, who's eating the costs and how long will they continue to eat the costs? Right now, it seems like maybe producers are eating a lot of those costs because they're looking a little bit further out and saying, all right, trade deals are happening. Maybe tariffs won't be long lived and we'll be able to maintain price levels. But on the other hand, you see some leading indicators, like, for example, manufacturers are paying higher prices for their inputs on basically every metric. That's a clear indication of inflation, at least partially due to tariffs because of their input costs are rising. And it just becomes a matter of when that will be passed through to consumers. And I think ultimately that does lead us back to as I said, 3% plus inflation on a core and most likely headline CPI basis.
Is what the Fed doing kind of unprecedented? Take a look at my chart here. I'm going to overlay the effective Fed funds rate with the U.S. inflation rate here. As you can see, if you zoom out, there tends to be a correlation over the long term, going back to the 50s. Whenever inflation goes up, you need to restrict monetary policy, and vice versa when it goes down. Right now, it seems like they're doing the exact opposite when inflation is inching up and they're cutting rates. Do we have a historical precedent for this?
Yeah, I mean, if you look back to the 80s and 90s and even the 70s, like for example, the 70s, you saw two waves of inflation, coupled with Fed rate. Everyone's probably seen that chart that overlays the 70s versus 2025. I think what the difference is here is like there. I don't really see a case where the Fed goes so crazy with rate cuts where they do a 75 bips cut or even 50 bips cut. Over the next call it 8-9 months. I don't really think that's necessary or going to happen. And I think you're also like the baseline is different. It's not like we have some impending crisis, some impending economic crisis where GDP is collapsing or there's nothing really causing panic where that would cause the Fed to have to move so quickly yet, at least. And in the past, typically that was the situation. So I think the Fed can and hopefully will continue to be calculated in this way in what they're doing. A 25 bips move here and there is not not huge or pretty average, historically speaking. And I think if they continue to take it meeting by meeting, you'll be able to at least keep things somewhat balanced on both sides of the dual mandate.
What happens to markets when the Fed cuts in an inflationary environment? Whether it be during a slowdown like stagflation or just normal growth, which assets typically perform the best when that happens?
Yeah. So obviously, I've mentioned, we think stocks are heading higher. I think also gold. We have been all over the gold for a long time. Fox Business always calls me the world's youngest gold bull, and we were calling for 3,500, and then now we're nearly at 3,800. I think we definitely are due for a pullback. We're starting to see some weakness over the last couple of days, but I think gold is heading to 4,000 plus. I also think that you're going to see the commodity world is interesting. Like if you look at oil prices, for example, inflation with oil typically will drive oil prices higher in time of inflation, just because oil is denominated in U.S. dollars, right? But the Trump admin has also been pretty vocal about keeping oil prices lower. They want oil below 60. So that's actually been a very tradable commodity. We were short and then we actually went long. And we actually just closed longs, and now we're kind of just somewhere in the middle around 65 a barrel. But I think there will be opportunities in the oil markets. And I also think Bitcoin is going to remain very strong. I think more record highs are ahead of us for Bitcoin. I wouldn't be surprised if we see $150,000 for Bitcoin by year end. And I really do think investors are going to just continue to search for yield in any form possible. They are going to search for yield because they know prices are going to continue to rise at a pace that's significantly above 2% per year.
So basically everything's going up, Adam. Everything's going up. What about bonds? We haven't talked about bonds. What do you see the yield going? I mean, are you bullish in bonds?
So that's a great question. That was going to be my next point. So we have not been chasing this bond rally recently as the 10-year has come back down towards 4%.
Yeah.
And that's something that I think I discussed this with you previously on this show, and I discussed it on a lot of different shows, is the fact that deficit spending is beyond out of control. The year-to-date fiscal 2025 deficit is at $2 trillion. We saw the deficit exceed $300 billion in August and nearly 300 in July. Tariff revenue is not even 10% of the monthly deficit that we're getting now. So I think in the background, you will see yields come down a little bit, but you're not going to see some huge drop off in yields because of the fact that the U.S. government continues to flood the treasury market with so much supply to fund deficit spending, and inflation's running high concurrently. I don't think that's a market that's a situation that's conducive of the 10-year falling to something crazy like 2 or 3% as we've seen historically.
I'm just curious on the gold front. The Fox is calling you the youngest gold will ever. Have you talked to your peers, friends of yours, associates who are also about your age? I'm just wondering if there's renewed interest with the younger crowd now that gold's at almost $4,000, pushing to 3,800. It's up 100% in 2 years. That's crypto levels of gains, almost. So
Yeah.
I'm just curious if that's attracted the younger crowd with this market. No? Yes?
Here and there, I would say, the young crowd is fixated on two things, AI and crypto. And I think that's been the case. I do think those that are really into markets, those that really follow markets and are searching for diversity in their portfolio are moving increasingly into gold, even physical gold. There's people that are buying physical gold. But I don't know. I think it's mixed. I think it really depends on the person. It depends on your investment style. And I think, by the way, like you need to not ignore the fact that gold is for sure has a lower beta than Bitcoin. It's definitely less risky than Bitcoin. So it is in a way still a hedge, even though it's moving concurrently with a high correlation coefficient to the S&P 500 and other risky assets. It really is still a hedge. So I wouldn't discount the value of it. I do think, to answer your question, I do think the younger generation is basically all in on AI and crypto. That from my conversations, that's the two biggest things that the younger people are asking me about.
How do you feel about the AI boom right now? Is that drawing to a close in terms of valuations, or is there still a lot more room to climb?
I personally think that we have a lot more room to climb. I think we're in the early days of AI. I think one day NVIDIA really could be the world's first $10 trillion company. And I think that people that are calling AI a bubble, two things can be true at once. It can be a bubble, and it can also be the next big thing. The internet was a bubble, and it was the next big thing. But I also think if you look at multiples, like forward multiples for NVIDIA, they're going down as the stock goes up, just because of how rapidly the operating metrics for NVIDIA are rising, and other tech giants, by the way. I mean, this can be said for other big stocks. So I think if you're in the right places, the AI revolution really does have a lot of room to run.
So we have to differentiate the two things you said. So something could be a bubble, but also could be the next great thing. The internet was a bubble, and the technology of the internet stayed, even when the bubble of the stocks popped. So let's just separate that. So I think we all agree that the AI revolution is here to stay. I mean, AI isn't going away. It's only accelerating. How about the tech companies and the VCs being pitched AI companies every single day in their inbox? Is that sector in a bubble?
I mean, look, a lot of it, there's so many varying degrees, right? Like
Sure.
I really think it's not like a company like NVIDIA or the Mag 7, a lot of the Mag 7 names, Microsoft, Google. It's not as speculative as you may think it is, because there's so much investment behind what they're saying, and there's already proven revenue and operating metrics that are effectively supporting the valuations we're seeing. If you get into the more small cap space or the more niche AI, things that we're seeing, yeah, I mean, there's definitely some things that are probably overhyped. They could be resemblant of a bubble. And even if we are in a bubble, it could still have a lot more room to run before it pops, right? I mean, investors in the 1990s that were able to, you could have traded the AI boom for 5 years before it popped, or more. So it's just because, even if you do think that we're in a bubble from either a valuation or technological perspective, it doesn't necessarily warrant just not doing anything over the near to medium term with your portfolfolio, in my view.
I understand. I'm going to close off on the consumer and the housing market before we take off now, Adam. New home sales soared 20% in August to a 3-year high. Surprised a lot of people. Sales of newly built homes rose to a much larger than expected 20.5% in August compared with July, to the highest level since January 2022. At the same time, though, same day, same news site, mortgage demand stalls after mini refinance boom. So less people applying for mortgages, more refinancing, and a lot more new home sales. What's going on?
Yeah, so if you look at the data, so the mortgage demand, let's start with that. So heading into the Fed decision on September 17th, there was a very big jump in mortgage demand. And that's because, of course, the market is forward looking. The market was pricing in the interest rate cut that was coming. and mortgage rates fell. If you look at early September, we saw one of the biggest single day drawdowns, actually the biggest single day drawdown in mortgage rates over the last 12 months, which is completely normal. People were refining, applying for mortgages into that weakness in the bond market and in yield. Sorry. Now, of course, the rate cut was implemented, and our view also was that yields were going to rise a little bit as a 50 bips cut was not coming, but the market was pricing in around a 10% probability of that happening. And as that has happened, yields have come up a little bit and rates have stopped falling, which makes sense as well. So it makes sense that a lot of the people that were looking to either refi or purchase a home and wait for a little bit of a drop in rates, they got that and they capitalized on it. That's why you also saw new home sales spike. But if you look at the broader picture, one, the average existing home, the median existing home price is now actually above the median new home price. And 1 out of 3 homes for sale are new inventory. And his supply remains historically low. So you have a situation where you have moderately warmer / hotter mortgage demand. You have a supply situation that's pretty much still constrained. And you have interest rates coming down a little bit, enough to drive some more demand, but not enough to remove what I like to call the financial disincentive for current homeowners and investors, more specifically, to sell property, right? Because like right now, if you're the average mortgage rate on a single family home right now in the US is, under 4%. Like basically the majority of people that own a home have a rate below 4%. And those people, and specifically investors, during the pandemic era, there was a huge resurgence of investors piling into these properties. Your biggest asset, even more than the home sometimes, could be the fact that you have a 2.5% interest rate on your mortgage, or 3%, or even 3.5%, more than basically half of where we are now. Those people don't want to sell. So that explains exactly what I was saying initially. You have a lot of new home supply because builders are building, and that's basically all you can buy. The supply situation is stagnant aside from those new homes. And mortgage rates are coming down. They're going to come down a little bit more, in my view, as the Fed cuts 25 basis points at a time and sees what's happening. But we're not going to have 3% mortgages again. So I actually think we're going to see much higher home prices ahead because of the fact that demand is going to resurge into a weak supply situation, and the market is going to largely remain as is, aside from that one factor, more demand into limited supply. I think that plays right into my view of assets concurrently all kind of rising into early to mid 2026.
I noticed that. One more question, I'll let you go. So, when the Fed funds rate was dropping, mid July 2024 to the end of the year 2024, I remember asking people, well, what does this mean for the housing market? We're going to start seeing a lot of new units being put on the market. And actually what we saw was no, people were actually just kind of waiting, I guess. You remember what happened then. What's different this time, Adam?
I mean, as far as, I don't think it's that different, to be honest. Yeah. I mean, home prices were up another 1% year over year in August. I think we're just kind of pumping more. The people that are looking for rates to come down a little bit, and they're looking at the market and they're thinking, okay, I'm going to wait. Maybe mortgage rates will come to 5.5%, maybe 4.75 if I'm really lucky, if there was some huge, drop off in the Fed funds rate. And those people are stimulating demand, but I don't see anything that's going to really cause supply to rise. And that's the golden factor here. If you look at previous housing market downturns, like take a look at 2008, you had foreclosures, right? You had a lot of things that were sending supply onto the market. Right now, I don't see an external shock factor that's going to really send a lot of supply into the market because, one, mortgage rates on existing homeowners are so low that most people are not falling behind on their mortgage debt. They're falling behind on auto debt and credit card debt, but not mortgage debt. Number two, the labor market is weakening, but we're not seeing like mass unemployment or mass layoffs happening. People are generally able to keep their jobs, or at least keep a part-time job right now. If they are already in one, it's more for new job market participants that are having trouble finding jobs. And you couple that together, and I really think supply remains fairly tight. It might alleviate a little bit, but not as much as demand's going to rebound as rates come down a little bit. And it leaves us in exactly what I was saying, that sweet spot where rates are low enough to drive prices higher, not drive, and supply remains limited. And I think we see higher home prices 1 year from today.
Excellent. All right. Thank you very much, Adam. Where can we follow you and learn more about you?
Thank you, David. Thanks for having me. You can follow us on every social media platform at Kobeissi Letter, and also the KobeisiLetter.com if you're interested in reading our reports. We publish a macroeconomic report. We cover the S&P, commodities, bonds, all the stuff I talked about today. We do like complete in-depth breakdowns and explain exactly what we're looking at investment-wise. Everything that we look at is basically weighted from a risk to reward basis, with a stop, a target, a stop loss, a target, and an entry. And we track all our performance. Transparency is what we try and do, is the name of our game. And we publish it in our annual reports on our website. So if you're interested to see how we've performed over the last 5 years, you can look at every single trade we've ever made directly on the KobeisiLetter.com.
Interesting. All right. Very good. Thank you very much, Adam. We'll take a look at that. Put the links down below, so make sure to follow the Kobeissi Letter there. Speak again soon, Adam. Take care for now.
Thank you, David. Thanks for having me.
Don't forget to subscribe and like, and we'll see you next time.